Welcome to Couple Bull. My name is Michael Dunham. I'm the Director of Planning here at Fontana Financial Planning. And with me today is Patrick Fontana, founder of Fontana Financial Planning. Welcome, Patrick.
Welcome, Michael. Thank you. Cheers.
Patrick, just to kind of set the tone for where we are at right now, we're recording this today on Monday, April 7th. And so what's happened here recently, the last two trading days, the market was down about 10.5%. If we look from the highs, intraday today, we hit minus 20% from the highs. And so understandably, there's a lot of people who are feeling a little uneasy, maybe feeling a little emotional, a little reactionary. And so I thought for this podcast, what may be good is we just open it up by just giving your advice to people who understandably feel that way.
Absolutely. So one of the things that we've looked at a lot is the history of the market, history of the S&P, particularly the red dot chart that shows the return every year, and then it marks the low point every year with a red dot. And we've looked at that a lot. The last couple of years, we've been particularly spoiled with the red dot was minus 10 and minus 8. 3 years ago, there was a little hiccup during the year, but finished quite high. Before that, the pandemic was 34%. And that was basically in 17 trading days, 33 days. It's pretty painful and powerful. But by the end of the year, the market was up fairly significantly. Mm-hmm. So for anybody that sells at a red dot, that's kind of the ultimate investing mistake. And that's where our investment policy statement that we used to have is written out as a bunch of sentences. Like, these are the rules. We've simplified it to never sell on a red dot. And that's been the way to, one of the ways to simplify the plan is start with the plan, rebalance, take advantage of movements in the market. Never sell on a red dot is kind of a principle that we repeat over and over. And this is when it's most challenging and most painful because of those things that we've talked about before, a little bit of things in our mind that, the high water mark is all that ever matters. It didn't matter. Like, if we back up more than a year to today, even with this pullback, it's about flat. Back up 2 years, we're up fairly significantly, and further back more so. So just looking at what are the smart behaviors, what are the things that we can take advantage of?
A little context I'll add to that too. So historically speaking, the market, the red dot that Patrick is talking about is minus 15% in any given year. If we take that a little bit further, we see a red dot of minus 30% or greater, roughly 1 out of every 5 years. So even these bigger declines are not unnormal, and they are something that we would say, if you're going to be an equity investor, if you're going to own stocks, it's smart to be prepared for the inevitability. We don't know when it's going to happen. We don't know what's going to cause it, but we do know that historically there can be severe declines in the market. And in order to reap the benefits of owning equities, you have to be willing to endure the short-term pain that sometimes comes.
Right. One thing I'd say is when we talk about owning great companies, that's what we're owning, and they navigate whatever comes, right? So interest rates, tariffs, geopolitical issues, terrorist attacks, whatever happens in the world, we're aligned by owning good companies that are navigating whatever happens, and they're on our side to get ahead and succeed and increase earnings and increase stock prices over time. And so just owning good companies rather than kind of this evil, the market, right? So it's the media is essentially our enemy with some of the stuff they put out, just fear on folks. And it's a lot of emotion. So when you go back to the plan, stick to the good behaviors, that is wise. And over time, we've seen it be rewarded over and over.
So if somebody's listening to this and they're buying into what we're saying and they agree, I want to do the smart behaviors, I want to do the smart things when the market is down, can you maybe talk through some of those smart things that somebody may want to consider doing?
Sure. So the first is rebalancing, right? So with our portfolios, example is 85% in equities and 15% kind of cash or municipal bonds. Rebalancing is when that 85-15 changes to 80-20, you take it back to 85-15. And then we've been actively looking at, idle cash that's long-term money to add to the portfolio. Adding on a red dot is a fantastic idea over time. And those behaviors are there. If you're looking at a Roth conversion, that's a good thing to do. If $100,000 value goes to 70, and you convert at that point, it's kind of, after the rebound, you've converted 100,000 when it was at a discount.
Mm-hmm. One thing, if you're adding cash, one smart way to do that is to just evaluate what tax deferred accounts do I plan to fund this year? And if you have the cash on hand to be able to fund them now, if you're going to do a backdoor Roth contribution, for example, this year, and you haven't done it yet, and you've got the money to deploy, that's one way to kind of take that one step further, is not only deploy the cash, but to do so in the tax advantaged accounts that you plan to fund for the year.
Absolutely.
And one other thing that I would bring up would just be dollar cost averaging, which a lot of people, maybe they don't recognize that they're doing it. But if you have a 401k plan where every single time you get paid, you have money going and being deferred into your 401k, you are naturally buying throughout the course of the cycle. As the market goes down, you're naturally buying every 2 weeks or however often you have money going into your 401k plan. And that's another way to take advantage of the downturns when they occur, is to, one, continue that. And then two, if there's capacity to increase your contributions, that's another great way to add cash to a tax advantaged account.
Right. And then, there's the side things that are on our I call them the great goals of life, things that you want to accomplish, funding kids' college. When it's on the list, that's a good place to add money when it's something that you're aspirationally wanting to check off the list and fund.
Perfect. Well, one last thing before we wrap up, I'll ask in the context of somebody who maybe is now living off of their investment portfolio. So the downturns, deploying cash is fantastic for people who are in what we would call the accumulation phase of life. Mm-hmm. So I'd like to ask, for the people that are in the decumulation phase of life, people who are actively living off of their investment portfolio, understandably, there may be a different type of anxiety for those people. What would your advice for somebody in that position be?
So when you look at the wealth that you've built, that in a lot of cases we've built together, and over time, we've had this happen over and over again. The red dots have repeated every year. As Michael said, the average is minus 15%. But from the moment I started in this business till now, we've had significant red dots, and every time it passes, right? So it's two words to kind of take to heart. To avoid this time is different. Of course, it's always different, but it's a crisis of the day that passes. And the more important thing to focus on is this too shall pass. And before it does pass and we're on to a new high and better times, take advantage of it by doing these activities, rebalancing, adding money. And we've got different mindsets of clients. And I love it when we get the call, hey, are we buying? Should we move money, move over, add money? The most successful investors, that's the attitude. And that's the way we want to be, is taking advantage of the situation. Volatility is a gift if you use it, and don't let it hurt you.
Mm-hmm. Awesome. Well, if you are watching this on YouTube, we'd encourage you to subscribe, like. If you're watching this on social media, same thing. We'd love if you liked or shared. And Patrick, how do we want to wrap it up?
Rebalance until rich.
Rebalance until rich. Thank you so much.